Welcome to the deep dive. If you're looking to cut through the noise and, truly understand what's driving market movements right now, you've definitely come to the right place.
Absolutely.
It feels like just 24 hours ago, the whole market narrative was completely different. Riding this wave of optimism,
Right.
then boom,
Yeah.
a flood of new data hits, and it just fundamentally alters the landscape. How do you even make sense of that kind of whiplash? This incredibly complex world of conflicting information.
Well, that's precisely what we're here to help you do.
Okay.
Our mission today, it's really custom tailored for your understanding. We've taken a stack of the most recent high-impact financial data, market intelligence, and we're going to distill it down
Distill it.
into clear, actionable insights. We'll help you identify those sort of hidden conflicts within the data and reveal why certain stocks are moving the way they are, and crucially, what it could mean for your grasp of the market.
And the central topic for this deep dive is this really dramatic reassessment of the U.S. economy, with some surprising, pretty immediate implications for specific stocks. I mean, including some of the biggest names in tech, right?
That's exactly it. We're going to uncover this unexpected interplay of macroeconomic data, Federal Reserve policy, and yeah, even some pretty dramatic political headlines that are now factoring in.
Okay, let's unpack this then. It really does feel like just yesterday, the market was absolutely soaring. There was this prevailing risk-on idea, this widespread belief the U.S. economy was headed for a perfect soft landing.
Yeah.
What exactly was underpinning that optimism?
You're right, that prior belief was incredibly strong. You had major indices hitting all-time highs, and it was all built on really a few core assumptions. A resilient U.S. economy, still showing growth,
No.
a sense that major geopolitical conflicts were de-escalating,
Right.
and maybe some constructive progress on international trade stuff. It really felt like smooth sailing was the default expectation.
And this is where it gets really interesting, because almost immediately after that peak optimism, we saw this sudden deluge of new macroeconomic data that just completely changed the picture. What was in that data dump?
It was a significant shift and kind of multifaceted. First, the big one. The U.S. Bureau of Economic Analysis, the BEA, released its third estimate for Q1 2025 GDP. And instead of continued expansion, it showed a contraction.
Contraction, wow.
Yeah, at a 0.5% annual pace. That's a material downgrade from previous estimates and a really stark reversal from the 2.4% expansion we saw just back in Q4 2024.
Okay, and why the contraction? What drove that?
It was primarily attributed to two things: increased imports, meaning we're buying more from overseas, and decreased government spending.
A GDP contraction is definitely a major headline shift. Were there other signals coming in alongside that?
Yes, that core GDP data was sort of corroborated by other signals pointing towards softening consumer health. Personal income actually decreased by 0.4% in May. And personal consumption expenditures, PCE, that fell by 0.1%, both suggesting, consumers might be tightening their belts.
Right.
And to compound that, the U.S. current account deficit, basically the difference between what we export and import, it widened substantially in Q1. Hit $450.2 billion, which is 6.0% of our current dollar GDP. That's up significantly from 4.2%. So essentially, we're importing a lot more than we're exporting, signaling a kind of fundamental economic imbalance.
So with all this new evidence pouring in, what does it actually mean for the market's previous soft landing hopes? The source material mentions applying a Bayesian inference framework here. Can you maybe break that down for us?
Sure. Basically, a Bayesian inference framework is just a fancy way of saying the market is constantly updating its beliefs based on new evidence. Think of it like a detective,
Okay.
gathering new clues and refining their theories. This new batch of data, the GDP contraction, the consumer softening it, drastically reduces the probability of that nice, smooth, soft landing.
So the odds are changing.
Exactly. The market's being forced to adjust its expectations, moving away from that optimistic scenario towards, well, other possibilities.
And what are these revised probabilities now? What
Yeah.
are the main scenarios we should be thinking about?
Well, the scenario that's now seen as most probable, jumping to 55% probability, that's up from just 30% before, is what's called a stagflationary drift.
Stagflationary drift. Okay, what does that look like?
That's where the U.S. economy either contracts, like we saw in Q1, or just stagnates, kind of treads water. But, and this is the key part, inflation remains stubbornly high, or it might even reaccelerate, maybe because of supply-side shocks like new trade tariffs.
Right, and the Fed in that situation.
The Fed is in a really difficult bind. They can't easily cut rates to boost the economy because inflation is still too high. It's a tough spot.
Okay, that's 55%. What are the other possibilities?
Next, there's a scenario scenario called the forced dovish pivot. That's now at 30% probability, up from 15%.
Forced dovish.
Yeah, here, the economic data gets so bad, deteriorates so sharply, that the Fed feels forced to cut interest rates, even if they're still worried about inflation, basically to prevent a really severe recession.
Okay, damage control.
Pretty much. And lastly, there's the resilient rebound scenario. This is the old favorite, the soft landing idea, where Q1 GDP was just a blip, an anomaly, and the economy bounces back strongly while inflation cools nicely.
And the odds on that now.
That's now the lowest probability, down to just 15%. That's a huge drop from the 55% probability it held before this data.
Wow, quite a shift in outlook. And the market, naturally, reacted immediately. U.S. stock futures pulled back sharply from those record highs we were just talking about.
They did. But there's another really fascinating layer here, connecting this directly to the Fed itself and politics.
Go on.
What's particularly striking is that Fed Chair Jerome Powell, speaking recently at an ECB conference, explicitly said something quite revealing. He stated they would likely have already cut rates if it weren't for the inflationary uncertainty being created by President Donald Trump's trade tariffs.
Wow. Okay, that's pretty direct.
It is. And it signals a fundamental shift. It essentially makes the Fed, as the source material put it, hostage to fiscal and trade decisions.
Hostage.
Yeah, meaning their monetary policy, their rate decisions are now heavily influenced, maybe even constrained, by political actions and rhetoric.
So for you listening, the implication is what? Watch the political news just as closely as the economic data.
That's exactly it. It's profound. Traders, investors, you now have to monitor political news, things like the ongoing U.S.-Canada trade tensions or new tariff threats as a primary input. It's right up there with CPI or GDP numbers now.
Okay, so we've got this huge macroeconomic earthquake, the shift in probabilities, the Fed tied up with politics. It makes the market feel incredibly complex right now. How does all this actually play out when we look at specific stocks?
Great question. That's where we're going next. We're going to dive into 5 key companies. We'll look at what's really driving their prices, and importantly, what conflicts, what competing forces are at play for each one.
How did you pick these 5?
We use a methodology, let's call it first principles relevance deconstruction. Basically, we focused on stocks with really high impact news recently, a significant market reaction, and what we see as a distinct psychological battleground.
Psychological battleground.
Yeah, where you can clearly see bullish and bearish forces clashing. It's in these conflicts, these seemingly contradictory signals, that you can often find the deepest insights. It's where those aha moments happen.
All right, I'm ready. Let's kick things off with NVIDIA, ticker NVDA, the AI superstar. I mean, the narrative around AI has been just overwhelmingly bullish. NVIDIA has been the poster child. But you're saying something interesting is happening here.
Indeed. The bullish case for NVIDIA, fundamentally, is still incredibly strong. You can't deny it. It is the dominant AI story. Record revenue, $44.1 billion. Astounding 73% year-over-year growth in their key data center segment.
Yeah, those numbers are huge.
Their new Blackwell AI supercomputer platform is in full production, and the analyst consensus is still overwhelmingly strong by. On paper, it looks fantastic.
It sounds like a clear winner, right? A stock just destined for more gains. But I sense a but coming. What's the other side of the coin here? How much weight should we give that?
That's where it gets really nuanced and where the conflict emerges. The bearish case, which is more based on sentiment and quantitative signals, is actually quite compelling right now. First, there are reports showing that insiders, including the CEO Jensen Huang himself, have sold, get this, over $1 billion worth of stock recently.
$1 billion. Wow. Okay, that's noticeable.
It's a powerful signal, you know, when the people who know the company best are selling that heavily. Plus, adding to that, a rare sell rating was just issued by Seaport Research. That kind of breaks the almost universal bullish consensus among analysts.
Interesting. Any technical signals pointing that way too?
Yes. Technical indicators like the MACD and RSI, which measure momentum, are showing a bearish short-term posture, suggesting the upward trend might be losing steam. And there's one more layer. Dark pool data.
The dark pools, what are they showing?
On June 27th, the short volume ratio in dark pools was high, 55.3%. That can indicate hidden institutional selling pressure, big players selling large blocks away from the public exchanges.
Okay, so you've got these amazing long-term fundamentals, this massive growth story, and then you have very active, very significant insider selling, a rare sell rating, bearish technicals, and potential hidden selling. That really does sound like a head-on collision of ideas. How do we make sense of that? How do you reconcile those conflicting signals?
It certainly looks like a conflict on the surface, but if you dig a bit deeper, you might see that these signals aren't necessarily contradictory. Maybe they're sequential.
Sequential. How so?
Well, heavy insider selling, especially from the CEO, often acts as a kind of leading indicator. It suggests that those with the most internal knowledge might believe the stock is near a short-term peak, even if they still believe in the long-term fundamentals.
I see. So the selling is about timing the current price, not necessarily a verdict on the company's future 5 years from now.
Potentially, yes. For the immediate future, that action from informed insiders arguably outweighs the longer-term story. It's like seeing the very first ripple in a pond before the wave builds. Our AI simulation, taking this into account, actually indicates a 65% probability of NVDA testing the $145–$150 support zone.
Why that zone specifically?
It seems to be driven by expectations of large block sales continuing and automated trading algorithms picking up on keywords like NVDA insider sale and reacting to them.
Okay, so what's the actionable plan here based on that analysis?
Well, for a bearish scenario, which the simulation gives a 70% probability, you'd be looking for a clear break and, importantly, a hold below $152. If that happens, potential targets could be around $148, then maybe $145. A key level to watch on the upside, perhaps for a stop loss or a sign the thesis is wrong, would be around $154.50.
Got it. Next up, Tesla, TSLA. And here's where you said we see a truly sharp confrontation of ideas. Because normally, bad macroeconomic news, like that GDP contraction we talked about, could actually be good for a growth stock like Tesla, couldn't it? Signals potential Fed rate cuts.
Exactly. That's the conventional wisdom, and it's usually right. The bullish case for Tesla should be macro-driven right now. Terrible GDP data increases the odds the Fed will cut rates. Lower rates benefit long-duration growth stocks like Tesla because it lowers the discount rate you apply to their future earnings, making them look more valuable today.
That's the theory.
That's the theory, and it's valid in many, many situations.
Tesla seems to have its own very specific storm clouds gathering
Yeah.
that might just ignore any macro tailwinds.
Indeed. The bearish case for Tesla is driven by severe company-specific risk, what we call idiosyncratic risk. It's unique to Tesla.
Okay, like what?
Well, first, there's a high probability, according to many analysts, of a truly disastrous Q2 delivery report coming soon. Some forecasts are predicting a massive 25% year-over-year drop in deliveries. The consensus is hovering around 385,000, which is still way down.
Oof, okay. That's big.
It is. And on top of that operational challenge, you have this escalating, very public feud between CEO Elon Musk and President Donald Trump. And crucially, this includes explicit threats to the federal subsidies that are absolutely key to Tesla's financial model and profitability.
Right, the bullshit.
Huge political risk. And technically, the stock's indicators are already showing what's described as a strongly bearish short-term bias.
So you have this potential macro tailwind from Fed cuts, but then this very specific, very personal, very political storm brewing just for Tesla. What's the critical distinction here? What's the aha moment for our listeners?
The critical distinction, the real takeaway here, is that idiosyncratic risk is paramount. The company's specific risks facing Tesla right now are simply too severe and too imminent to be ignored. They have the potential to completely overwhelm any benefit from broader macro trends like potential rate cuts.
So the stock could just decouple, go its own way, regardless of what the wider market does.
Exactly. That's the crucial point for you. Tesla might decorrelate from the broader market, even from its own tech or auto sector, because its problems are so uniquely its own. Our AI simulation reflects this, giving a 70% probability of a negative price reaction after the delivery data is released.
How negative?
Potentially a 4–6% gap down on the opening if deliveries come in that weak zone, say 330,000 to 360,000. For any kind of relief rally, they'd need a significant beat, maybe above 400,000 deliveries, and the simulation puts the probability of that under 20%.
Okay, so what's the plan for a likely bearish outcome?
For the bearish scenario, with an 80% probability assigned. If those Q2 deliveries meet the low expectations or miss them around that 300 to 85K mark, you'd watch for either a gap down at the open or a decisive break below $298. Potential downside targets could be $290, then maybe $282. A key risk management level, maybe a stop loss, would be around $305.
Fascinating. Okay, moving from the giants to something different. If you want to understand market psychology at its most extreme, you mentioned BigBear.ai, ticker BBAI. This one sounds like a pure battleground.
It truly is. It's a perfect case study in speculative dynamics. The bullish case is actually quite simple, purely from a trend perspective.
Right.
It's trading significantly above all its key moving averages, the 5-day, 10-day, 20, 50, 100, 200-day. That is a classic textbook uptrend signal. Suggests strong upward momentum has been in place.
Right, looks good on the surface trend-wise.
Yeah.
But then you said its momentum indicators are telling a completely different story. It feels like looking at two opposing charts.
Precisely. The bearish case, based on momentum, is stark. Its relative strength index, the RSI, is way up at 71.08. That's firmly in overbought territory and flashing a sell signal for many traders. It suggests the rally might be stretched, unsustainable.
Okay, overbought. What else?
The MACD, another key momentum indicator, is also showing a bearish crossover, again suggesting that the upward energy driving the stock is getting exhausted. Quantitatively, the volume has been absolutely astronomical, 255 million shares traded recently compared to its 100 million average. Huge interest, huge activity.
But is there anything fundamental backing this move?
That's the thing. Fundamentally, the company looks weak. It missed its recent earnings per share and revenue estimates. It's unprofitable. Sentiment-wise, it seems driven purely by hype and speculation around anything AI. Some analysts even see it as a kind of market froth indicator.
So clear uptrend on the chart, but screaming overbought and exhausted on momentum with weak fundamentals and pure hype driving it. How on earth do you make sense of that contradiction? What does it predict?
Well, here's the interesting part. For a highly speculative stock like this, with weak fundamentals, this kind of stark divergence between the trend and the momentum indicators doesn't actually predict a specific direction.
It doesn't. Then what does it predict?
It forecasts volatility, an imminent explosive move. Our AI simulation gives this an 85% probability, a price move greater than 15%, either up or down, likely within the next 24 to 48 hours.
15% either way. Okay, so what causes that move?
The simulation sees two primary paths. One is a gamma squeeze. That's a technical event where options market activity forces dealers to buy the underlying stock rapidly, pushing the price up violently.
Right.
The other path is a momentum collapse, where the rally just runs out of buyers, the hype fades, and everyone rushes for the exit at once, causing a sharp drop.
So basically a 50-50 shot at a huge move up or down. How do you even strategize for that?
You prepare for either possibility. It's high risk, high reward. For a bullish squeeze scenario, you'd watch for a decisive break and, crucially, a hold above $6.70, and it needs to be on massive volume, think over 150 million shares. If that happens, potential targets might be $7.50, then maybe $8.50. A key risk level or stop loss would be around $6.20.
And the bearish side?
For a bearish momentum collapse, you'd look for a failure to break above that $6.70 level, followed by a break below $6.20 on heavy selling volume. Targets there could be $5.50, then maybe $4.80. A stop loss level in this case would be placed back above $6.70. It's a very volatile setup.
Definitely sounds like one for the risk takers. Okay, let's shift gears now to something more fundamentally driven, Array Technologies, ARAY. You said this offers a compelling bullish case based on solid corporate action, not just speculation.
That's right. The relevance thesis here is different. It's a mid-cap stock, maybe less known, but it's undergoing what looks like a significant re-rating by the market. And it's driven by a fundamentally positive corporate action they just took.
Okay, what was the action?
The key catalyst was the successful closing of an upsized $345 million convertible senior notes offering. Now, that might sound like financial jargon, but what they did with the money is important.
Right.
They used it strategically to refinance older, higher-cost debt. They repurchased some other notes at a discount, and they extended their overall debt maturities. The bottom line impact: an estimated $9 million in annual interest expense savings.
Okay, so real money saved, dropping straight to the bottom line. That's tangible.
Yes, it's a clear, quantifiable financial benefit that improves their balance sheet and profitability profile.
And you mentioned they also did something smart with capped calls.
Yeah.
It sounded like a bullish sign.
Absolutely. They spent $35 million of the proceeds on what are called capped calls. This is a strategy companies use alongside convertible debt to effectively raise the price at which the debt converts into shares. In this case, it protects shareholders from dilution if the share price appreciates significantly, specifically between $8.12 and $12.74.
So management is basically betting the stock will go up, but protecting shareholders if it goes up a lot.
Precisely. It's a strong bullish signal of management's confidence in the company's future upside. And the market seemed to agree. The stock jumped 12.5% on the news, on double its daily average volume, created strong positive momentum.
So what's the outlook here according to the analysis?
Our AI simulation assigns a 60% probability to a continued bullish scenario. It suggests the stock might retest and find support in the $6.40 zone, perhaps on a minor pullback, and then move back through the recent resistance around $6.70. Potential upside targets from there could be $7.25, then maybe that lower bound of the capped call at $8.12. A risk management level, maybe a stop, could be placed around $5.90.
Interesting. A solid fundamental story driving that one. And finally, let's look at Triumph Financial, TFIN. You mentioned this one shows powerful signals of insider conviction, which is a sharp contrast to what we saw at NVIDIA, right?
Indeed. TFIN presents another mid-cap story, this time a technical breakout that seems propelled by both strategic corporate news and that clear insider conviction.
Okay, what are the key catalysts driving TFIN?
There are really two main ones. First, the insider activity. Multiple company directors have been buying shares on the open market in the last 3 months. That's a classic high conviction signal, the opposite of the heavy insider selling we discussed at NVIDIA.
Management putting their own money on the line.
Exactly. It signals strong belief from the inside. Second, they recently acquired a freight tech company called greenscreens.ai. The goal here is to enhance their intelligence segment, specifically for the freight and transportation industry. This hints at a potential narrative shift for the company, maybe towards being seen more as a fintech or a transportation tech play, which could attract a broader set of investors.
Okay, so insider buying plus a strategic tech acquisition. How did the market react?
The market reacted positively. An 11% surge in the stock price on nearly double its average volume shows strong initial endorsement of these moves.
So another potentially compelling story, driven by internal factors. What's the strategic outlook or plan here?
Our AI simulation points to a 65% probability for the bullish scenario to continue. The idea would be for the price to hold above the $59 level on any pullback, consolidating the recent gains, and then make a move through its recent high, which was around $61.50. If that happens, potential targets could be $65, then maybe $68. A logical risk management level or stop loss might be placed just below that support, around $58. It's another case where a compelling company-specific story could potentially defy broader market headwinds because the drivers are internal and seem to have strong conviction behind them.
Okay, fantastic. We've unpacked 5 very different stock stories, each with its own conflicts and drivers. Now, let's try to connect this back to the bigger picture. We started with that macroeconomic earthquake. What's the overarching lesson here for your approach, for the listener's approach to the market right now?
I think a critical insight really crystallized by the Tesla analysis is this idea of a potential correlation breakdown.
Correlation breakdown.
Yeah. Normally, you'd expect certain relationships. Like we said, bad macro news increases odds of Fed cuts, which should boost growth stocks like Tesla. That's a typical correlation.
Right. Bad news is good news sometimes.
Exactly. But what the Tesla situation highlights is that severe, company-specific, idiosyncratic risks, especially politically charged ones like threats to subsidies, can completely overwhelm those typical correlations.
So even if the Fed does pivot and cut rates, which should lift the Nasdaq, Tesla's own drama could cause it to fall anyway. It decouples.
Precisely. Tesla's facing these intense company-specific threats that are essentially independent of the broader macro cycle or Fed policy. So the stock could fall even if the rest of the tech sector rallies on dovish Fed hopes. This raises a really important question for you, the listener, to consider.
Which is?
How do you assess a stock's risk when these traditional rules, these correlations, might not apply anymore? When company-specific drama, political factors can just overwhelm everything else, it means you really have to dig into those unique drivers for each company.
That's a huge takeaway. We're dealing with a market where even the usual relationships are potentially breaking down. Given that complexity, how do these 5 scenarios we discussed stack up? Is there a way to rank them in terms of conviction or strategic approach?
Yes, we can try to rank them based on clarity and conviction.
Yeah.
NVIDIA, with the bearish outlook due to insider sales, and Tesla, bearish due to idiosyncratic risk, would rank highest for conviction right now. Why? Because they have very clear near-term catalysts and multiple signals, even conflicting ones, that align towards a specific directional bias in the short term. They present clear, though complex, tradable narratives.
Okay, high conviction on the bearish cases for NVDA and TSLA despite the macro noise. What about the others?
Array Technologies, ARI, and Triumph Financial, TFIN, would be ranked medium. They represent idiosyncratic bullish plays. They have strong company-specific stories and catalysts, the debt refinancing for ARI, the insider buying and acquisition for TFIN. However, they still carry some broader market or sector risk. If the whole market tanks due to macro fears, even good stories can get pulled down.
Makes sense. And BigBear.ai.
BigBear.ai, BBAI, is definitely ranked low in terms of predictable conviction. It's pure speculation at this point. The conflicting signals forecast volatility, not direction. It's more akin to a lottery ticket. Huge potential payoff, but equally huge risk. Really only suitable for highly risk-tolerant traders who understand that extreme volatility and the potential for sharp losses.
That's a really helpful way to frame it. So wrapping this all up, what you, the listener, now have is hopefully a clearer point of view. We've aimed to provide actionable advice, a strategic framework, and really a well-defined plan for navigating these complex dynamics.
Exactly. For each stock we dove into, we've highlighted specific bullish and bearish triggers, potential price zones to watch, and key risk management levels.
And the goal is to help you not just see what is moving in the market, but to fundamentally understand the why behind those movements. That understanding is what allows you to adapt your own strategy and make more informed decisions in this environment. It's truly incredible how quickly the market narrative can pivot, isn't it? And it just underscores how crucial it is to have this kind of deep distilled knowledge, not just headlines, understanding not just what's happening, but why it really matters. It feels like the key advantage in navigating these dynamic markets.
And that really is the core of it. The market, perhaps more than ever, is becoming a reflection not just of traditional economic fundamentals, but also these unpredictable political forces, shifts in crowd psychology,
Mhm.
and these idiosyncratic company stories. So, a final thought for you to mull over. As you move forward, how will you adapt your own approach to better distinguish between the market noise and the truly actionable signals in this new, multifaceted environment?
That's a critical question, definitely something to think about. And we hope today's deep dive has given you some powerful tools and frameworks to help you do just that. If you want the fastest, most frequent updates, the kind of insights that aim to cut through that noise and deliver those aha moments of understanding, then please make sure to subscribe to the deep dive. Thank you so much for joining us today as we decoded these market shifts and hidden signals.